3. Working capital management. Working capital management refers to the management of a company's short-term assets and liabilities. It includes the management of cash, accounts receivable, inventory, and accounts payable. The objective of working capital management is to ensure that a company has enough liquidity to meet its short-term obligations and to maximize its profitability. This video provides a comprehensive review of best practices in working capital management. Importance of working capital management. Working capital management is important for several reasons. First, it ensures that a company has enough liquidity to meet its short-term obligations. Second, it maximizes the profitability of a company by minimizing the cost of financing working capital. Third, it helps a company to manage its growth by ensuring that it has enough cash to fund its operations. Fourth, it helps a company to manage its risk by minimizing the risk of default or bankruptcy. Key components of working capital. The key components of working capital include cash, accounts receivable, inventory, and accounts payable. Cash is the most liquid asset and is used to meet short-term obligations. Accounts receivable is the money owed to a company by its customers for goods and services sold on credit. Inventory is the goods held by a company for sale or production. Accounts payable is the money owed by a company to its suppliers for goods and services purchased on credit. Best practices in working capital management. The best practices in working capital management include managing each component of working capital effectively. For cash management, companies should develop cash budgets and cash flow statements to monitor cash inflows and outflows. For accounts receivable management, companies should establish credit policies and procedures to minimize the risk of default by customers. For inventory management, companies should adopt just-in-time inventory systems to minimize inventory levels and maximize inventory turnover. For accounts payable management, companies should negotiate favorable payment terms with suppliers to maximize cash flow. Approaches to working capital management. There are several approaches to working capital management, including the cash conversion cycle, the operating cycle, and the net working capital approach. The cash conversion cycle measures the time it takes for a company to convert its investments in inventory and accounts receivable into cash. The operating cycle measures the time it takes for a company to convert its investments in inventory into cash. The net working capital approach measures the difference between a company's current assets and current liabilities. Conclusion. Working capital management is a critical aspect of financial management that can have a significant impact on a company's profitability and growth. Effective working capital management requires the management of each component of working capital and the adoption of best practices. Companies should also adopt appropriate approaches to working capital management to ensure that they have enough liquidity to meet their short-term obligations and to maximize their profitability.